Good. So I
Excellent.
see another 60, 70 people connected. We're going to give it another couple of minutes. I see people already writing in the chat function and the Q&A. Good morning. Already people asking questions. Can you clarify how to define SME and Freezone entity? We're going to get to that. Good morning, everyone. I see Sean connecting. Good morning. Mustafa. Maybe in the meantime, as we wait a little bit longer, for those that are connecting, tell us, where are you connecting from? Are you in the UAE? Do you already own a business here in the UAE? Do you own an existing company? Where are you connecting from? Are you a Creative Zone client? A little information that we can get from people. I see 90 people connected and keeps on growing. It's a good topic. It's a very hot topic nowadays with the changes coming up and getting started in June, Nilesh, correct? So I can imagine you're getting a lot of requests, a lot of people asking information on this, correct?
Yeah, no, absolutely. I think it's a very relevant topic and conversation for most businesses. Because there are very few jurisdictions that we may have all experienced that has transitioned into a new corporate tax regime. So preparing for that is obviously critical for businesses. So yeah, no, it's been a very busy period with lots of conversations with clients and businesses on what they need to do to get ready.
Indeed. I see people writing based in the UAE, transferring to the UAE as an investor soon. You're welcome. Our doors are open. India, investor in Maidan Freezone. Excellent. Good to see you, Arun. From Germany, not company in the UAE yet, planning to this year. Ben, well, indeed, we have a lot of German customers and clients that are slowly moving their businesses or operating from here as well, having a plan B, and they're starting to slowly set roots in the UAE. Maybe as a soft opening, Nilesh, if we could do a bit of an introduction on why is it that the UAE is now entering into this new phase of slowly including a 9% corporate tax. How does this change the landscape of things? Where do we position ourselves compared to other jurisdictions around the region, around the world? And what are the benefits, I would say, for the UAE and for people living and operating from here in being aligned with a little bit more of what it's to be this international phase where corporate taxes exists in different jurisdictions?
Yeah, Lorenzo, I think this, the introduction of corporate tax for UAE in my view is a progressive move by the government. There has been lots of pressure from the international community on UAE to align its fiscal policy in line with global standards and global requirements. UAE is part of the inclusive framework network of the OECD, and as part of that network, it has committed to the global community to initiate measures, introduce legislation to dissuade multinational groups from shifting profits from high tax to low tax jurisdictions, which UAE historically or currently is. And I think as part of that commitment, a new corporate tax regime is probably a step in the right direction. The 9% rate is one of the most attractive rates worldwide. There is, besides those countries that do not have a tax regime, in the GCC, it's the lowest corporate tax rate other than Bahrain, which does not have a corporate tax system. And even globally, other than Hungary, which is at 9%. Again, it's one of the lowest corporate tax regimes in the world. And along with that, I think when we go through the discussion in more detail, some of the legislation is actually meant to be fairly simple and attractive for businesses to set up operations in the UAE, set up holding companies in the UAE without the onerous burden of an actual tax liability. But the whole tax reporting system, filing of tax returns, sharing information with the tax authorities actually gives a lot of stability and confidence, in my view, to the business community for doing business in UAE with customers and other businesses alike.
Yeah, indeed. And I think you touched on a key word there, making it simple and effective. I think people in general, they're not afraid of a 9% corporate tax, but it's more to do with making it simply and efficient and easy for investors to navigate through this. And partly this is a little bit of our help and support here, is to try to break this down, and how is it that we can sort of put out this information so that we can help, you know, our investors and our clients to navigate through this. But this is a key thing, right? In how is the UAE making it in an efficient way in rolling this new corporate tax?
Yeah, I mean, clearly, and there is still a lot of work to be done. The Ministry of Finance and the FTA are working really hard to get the relevant guidance pulled together. We are awaiting guidance on a number of areas where the law, still has updates to be provided, and we would expect the government and the ministries to take in all input from stakeholders. There was a public consultation document which was launched last year to take input from businesses. Hopefully some of that will be fed into the system, and again, this is unheard of in the UAE environment in the past. Particularly when things like the VAT legislation was issued, there was never a consultation process, which is a very very mature way of looking at implementing a new tax regime, where you take input from businesses, take input from stakeholders on areas that are likely to be of most impact to a successful rollout of a corporate tax regime.
Excellent. Perfect. Well, we have 150 people connected. I think we can get straight into the topic of today, which is the corporate tax law introduced. As we're all aware, starting June the 1st, the new coming corporate tax is coming on stream for anybody that is running a business, operating a business, and doing business with people within the UAE. There's some differences, who qualifies, who doesn't. We're going to be touching upon those things, Nilesh, with the team as well, Sishan and Mohammed. But again, thank you, Nilesh, Sishan, and Mohammed, for taking the time. Let me make some quick introductions on who these people are. But Nilesh Ashar is the Senior Managing Director and Head of Middle East Tax for FTI Consulting. Sishan Tour is the General Manager at Creative Zone Tax and Accounting. And Mohammed Al Sayed is the Head of Tax at Creative Zone Tax and Accounting. So gentlemen, again, thank you so much for taking the time, for being here with us today.
Thank you, Lorenzo.
Thank you.
So as we were saying, maybe Nilesh, to start with you, where should companies be at this stage? June the 1st is around the corner. If I am an SME, I am a company, where should I be at when it comes to, should I have been already registered with the tax authorities? How is it that I should be prepared for June the 1st? And how is it that my company should be aligned with observing the new regulations when it comes to corporate tax?
Yeah, I think it's, Lorenzo, I think firstly on June the 1st is when the law goes into effect for businesses that have a financial year starting 1st of June. So for most businesses that are on a calendar year basis, the effective date for the corporate tax is the 1st of January 2024. So I think the first thing to look at is what's your calendar year end? For most businesses in India, for example, the calendar year end, the fiscal year is 31st of March. So for those businesses, the first tax period where corporate tax will come into effect will be the 1st of April 2024. For those on a calendar year basis, it'll be the 1st of Jan. And so you need to, first thing is to look at when does the law come into effect for you. And obviously as part of, once you've determined that, then there are a number of areas that need to be looked at in preparation for corporate tax, and we'll run through them in more detail. But to answer your specific question, the registration for corporate tax has been opened up only for certain large businesses, which will be on an invitation basis by the FTA. There is no, other businesses do not yet have the obligation or possibility to register. I think unlike VAT, where once the law goes into effect, the VAT registration and filings are during the course of the year. So if when VAT came in on 1st of January 2018, the first tax period was either a month or a quarter. So you had the first filing at the end of February or the end of at the end of March or thereabouts. But for corporate tax, the taxable period is obviously the tax year, but the tax returns have to be filed 9 months from the year end. So there is time for businesses to still register. But that doesn't mean there's nothing to be done until then. I think businesses do need to consider the impact of a number of areas like tax grouping, their intercompany transactions, put in place arrangements that are in compliance with the tax laws. And all of that has to be done prior to the law coming into effect for the individual business. And we'll talk through those in a bit more detail in this webinar.
Excellent. Maybe perhaps Ishan, on a similar scope of question, what has been your experience with people reaching out to you and our clients at Creative Zone on the registration of things? Is it a clear way forward for SMEs, for companies? How do we go and how do they go about registering themselves with the tax authorities?
Well, as Nilesh said, that right now it's been open on an invitational basis to large companies. However, what we've seen and experienced through some client portals on FTA is some clients, or I think it's most clients, have an option to apply for registration, but it's not fully functional. There are some glitches, there are some technical issues, and also because the regulations are not out completely. Specifically when we discuss about tax groups and having how to register them, because we don't want a situation where companies register them and then they have to become a part of the tax group and they have to change the registration. So we don't advise right now to register as of, even if it's open to your company's portal. But from a client's perspective, we've seen clients who are more eager to know about corporate tax registration than they were when VAT came into place. So there is more awareness from the client's perspective, and that's how we're tackling these situations. We're not making them rush into registrations and doing it's as Nilesh said, that there's enough time for companies to make sure they're ready and they do the right thing at the right time. So we're also advising the clients accordingly.
All right. So before we go into the old age questions, do I qualify? Do I don't? I operate in a Freezone company and most of my business I'm doing from abroad. What happens if I invoice somebody in the mainland? We're going to start into those specific questions. Maybe from Mohammed, from your side, still on this area of how should I be getting prepared and organized? Maybe through aspects of bookkeeping, on bookkeeping, auditing. What should SMEs start organizing themselves from a bookkeeping point of view? Should they prepare themselves for audit? What kind of reporting they should start creating themselves used to for when it comes to when things do open fully up for them to be fully ready?
So business, Lorenzo, are now required to be in the preparation phase where they have their financial statements and the books ready, where they need to look at intercompany transactions, and if they are at a group level, that they need to look at the group transactions. All of this needs to be looked at now and to be prepared properly, so you would be starting the corporate tax with your books clear. Regarding the audits, up to now, we don't have clearance from the tax authority whether specific businesses, whether Freezone or mainland, would be required to submit annual audits. So up to now, we don't suggest or advise clients to proceed with audits as it's not mandatory up to now. But the most important is to prepare the books, have everything clear, as we sometimes experience some of the clients that we have that are individuals or freelancers. They don't maintain their accounting records up to now, but now it's the essential stage where businesses must keep their books ready.
Excellent. Good. All right, Nilesh. So if we could go a little bit deeper onto the case now, who does this apply for? What kind of scenarios can we start putting out there so that people relate to this? We have differences of people operating under Freezone entities, mainland businesses. What will happen when you start doing business with people on the mainland? We have the threshold of 375,000 dirhams that need to be crossed. What happens if we operate under a net profit of 375, do we still need to apply for tax? Yeah, take us through a little bit some of these scenarios.
Sorry, yeah. So Lorenzo, I think I've got a few slides to share. Happy to walk through the slides and we can treat this as a conversation. Don't have to go through all of the slides at the same time, but let me just put this. Are you?
We're seeing a Zoom screen, but
okay, hold on.
Switched off.
Okay, hold on.
And in the meantime, for all the attendees out there, we have over 200 people connected, and we're very glad to see such a good group of people connecting. Please send us your questions on the Q&A function or on the chat function as well, in the chat box. I'll be trying to read a few questions as we go along. A lot of questions on free zones, freelance companies. We're going to start addressing some of those. So please feel free and send us your questions, and we're going to try to address most of those. So yes, Nilesh, now we can see your full screen.
Yeah. So I think I talked through the timeline right from January last year, when the announcement came in for introduction of corporate tax, to the public consultation that was launched in April, where feedback was invited from the businesses, as I mentioned. We then had the law that came in on 9th of December 2022. The law applies on 1st of June 2023 is the go live date, but companies with a calendar year end, as we talked about, will be 1st of January 24. The actual first tax return is not due until February 2025 for those businesses that have a June start for their tax year. But those with a calendar year basis, the first deadline to file the tax return will be 30th of September 2025. I think that who the tax applies to is, I think before we go into thresholds and limits, the tax applies to resident persons, and it applies to both natural persons and juridical persons. So if you are a UAE company, you are a resident for UAE tax purposes and will be subject to tax on your income, subject to the free zone regime, etc., which we'll come on to in a moment. Even natural persons conducting a business activity in the UAE are taxed in the UAE, and I'll spend some time on this in a moment. Foreign persons, non-resident persons, whether they are juridical persons or individuals, are subject to tax if they have what's called a permanent establishment in the UAE, or a source of income in the UAE, or any nexus to the UAE. While there is a definition of permanent establishment and a UAE source, it does basically include any income that's paid out by a UAE resident person, any income that's any amount or income that's earned in relation to an activity or an asset explored or exploited in the UAE, and where there is a nexus in the UAE, and the term nexus is yet to be defined by the Ministry of Finance. There are special rules for unincorporated partnerships, where unincorporated partnerships are essentially looked through for tax purposes, and the partners of the partnerships carrying on a business are taxable in respect of the activities or the income that arises from the business. There are certain exemptions or exempt categories of people, which are essentially government entities, institution funds, those that are investment funds, those that are involved in charitable or public benefit causes. Those are the ones that are exempt. Those that are in the extractive industries, oil and gas exploration activities, those are the ones that are also exempt. Free zone person, and we'll spend more time on this. If you are a free zone person, then any qualifying income earned by a free zone person is subject to a 0% tax rate, and any non-qualifying income is subject to the 9% tax rate. And this is where what is meant by qualifying person or qualifying income is not, or is yet to be defined. We've got some guidance from the public consultation document in the past, which I'll come on to in a moment. But essentially, for a free zone company to be subject to a 0% tax rate, they do need to earn qualifying income. And any non-qualifying income is fully taxable. But besides that, even if you earn qualifying income, it's not an automatic exemption or an automatic 0% tax rate. You also need to comply with ESR and substance requirements, and also transfer pricing requirements for any related party transactions that a free zone person may be entering into with its group companies or with its connected persons. The rate of tax is 375,000. So his rate of tax is 0% for income up to 375,000 dirhams. Anything in exceeding that is 9%. For free zone person, qualifying income is subject to 0%. Non-qualifying income is subject to 9%. There is also a small business relief where the rate of tax is 0% or the business is considered as having no taxable income. The small business relief will be subject to businesses that meet the criteria will be subject to simplified reporting obligations, so simpler tax returns, simpler registration requirements. However, what qualifies as a small business is yet to be defined by the Ministry of Finance under a cabinet decision. The expectation is that there will be a revenue threshold that will be set out in the cabinet decision to define a small business. And if you fall within that revenue threshold, then essentially you're a small business that is subject to a 0% tax rate with a simpler tax filing obligation. So when you look at the 375,000 dirham limit, unlike VAT, which was a turnover specific threshold, for corporate tax purposes, it is a 375,000 dirham of profits, which is essentially revenues less expenses. So if your revenues are 2 million dirhams, and your expenses are 1.7 million dirhams, your taxable income is 300,000 dirhams. And if that's the accurate description of your accounting profit, then essentially you will be subject to a 0% tax rate. But that doesn't mean that there are no obligations to be done. It is expected that such businesses will still need to register for tax, get a tax registration number, file a tax return, reporting the profit of 300,000 in my example, in order to be eligible for the 0% rate. There are onerous obligations on transfer pricing and connected persons.
Sorry to butt in there. Maybe before we go into transfer pricing, this topic of qualifying income and non-qualifying income, if we can go a little deeper, I think people might have questions. What is qualifying income? What not? What falls under? What will be subject to tax and what not?
Yeah. So let me do this. I can come back to if you just it's covered on my next slide. So if you just bear with me for a minute, and I'll come back to qualifying income, non-qualifying income.
Excellent.
I just wanted to set out a couple of other areas before we go to this. Because for a free zone person, even if you earn qualifying income, transfer pricing is extremely relevant, because you cannot get the 0% rate for qualifying income unless and until you are in compliance with transfer price. The free zone entity is also in compliance with transfer pricing. So where the free zone company has related party and connected person transactions, and there's a definition of what these are, and essentially there are other companies which are 50% directly or indirectly or commonly owned, and connected persons where payments are made to owners and owners' relatives, and companies owned by owners, where payments are made by the company. Because there is no personal tax in the UAE, obviously those incomes are not subject to tax. So you need to be in compliance with transfer pricing provisions, as well as transfer pricing documentation. And then the tax computation, essentially your starting point is your accounting profit, and which is then adjusted by a number of additions and disallowances, which we can talk about in a bit more detail later on in the slide. But to come back, Lorenzo, to your question on qualifying income. So I think it's just useful to go back to the history slightly on what were the provisions in the public consultation document that the Ministry of Finance had set out in April of last year, where under that document, which is not the law, it was the guidance, or it was something which was a thinking of the government at that point in time. Qualifying income at that point was defined or was meant to include any income from transactions outside the UAE, and any income from trading or conducting business with other free zone businesses. And the free zone company could only benefit from the 0% rate if the mainland income, if they did any business with mainland, it was considered to be taxable, except if the mainland income was passive income. So if a free zone company earned interest, royalties, dividends, and capital gains from a mainland entity, then that was subject to a 0% tax, or that was meant to subject to 0% tax also. And it also applied to transactions between a free zone company and its mainland group company, were also any income earned by a free zone company from its mainland group company was also meant to be subject to a 0% tax rate.
So
However,
let me get that scenario
Yeah.
straight. So let's say that we have someone that has a holding entity that is registered in one of the free zones and owns an operating company in the mainland. When there is a payment of dividends back into the holding entity, that holding entity that is based in the free zone is not subject to tax on that income?
so under the actual law, the answer is yes. Now, it doesn't matter whether it's a if that holding company is in the free zone or not. Any dividends earned by a UAE company, whether in a free zone or not in the free zone, to the extent it comes from another UAE company,
Mhm.
is exempt from tax.
Okay.
So a mainland company that gives a dividend to another mainland company or to a free zone company
Uh-huh.
is subject to is not taxable on that dividend income.
Mhm.
But the public consultation document expressly called it out in the consultation document. The one thing that was not clear in the consultation document was whether it's an all or nothing approach. So even if you had a single dirham of income from mainland activity, arguably that negated the entire exemption. And equally, what was not clear is what happens to B2C transactions. So if you had a supermarket in the free zone, or a restaurant in the free zone that serviced or catered to end consumers like you and me, does the exemption apply? Again, that was not clear. Now, this is all history. What the law actually says is that as long as you earn qualifying income, you are subject to 0% rate. And as I said, the $1 million question, which is not yet clarified, where we expect guidance to come from the Ministry of Finance, is what is meant by qualifying income. And that's not clear. And the reason I gave the history of what happened in the public consultation document was that consultation document gave some indication of what is likely to be included as qualifying income, but the law is actually silent and says that it will be clarified in a Ministry of Finance or cabinet decision. But the expectation is, my expectation is that any income that a free zone company earns from business activities outside the UAE or from other free zone entities will be subject to 0%. And to the extent it carries out activities with mainland customers, those activities will be subject to a 9% rate. So unlike the public consultation document where even a single dirham of income negated your entire exemption, it looks like you've got a proportionate approach as opposed to an all or nothing approach. But in order to claim that exemption, the free zone company needs to maintain adequate substance, which is not defined but is expected to be linked to be in compliance with ESR types of requirements. And the free zone company has not elected to be part of the corporate tax regime. Now, you might say, why would you elect to be part of a corporate tax regime if you're a free zone company? There could be a number of reasons for that. If the free zone company has, one of the restrictions of being a free zone company is that a free zone company cannot form a tax group with a mainland company, because obviously it is subject to a 0% tax rate. So to the extent a free zone company does not meet the requirements of, has not elected to be part of the tax group, it cannot form a tax grouping criteria. So it may elect, so the free zone company should not elect to be part of the tax regime. And it needs to be in compliance with transfer pricing rules and transfer pricing documentation in order to qualify for the 0% rate. As I said, qualifying income is yet to be prescribed, so we're all eagerly awaiting that guidance or that decision from the Ministry of Finance. And what's also, if you read the law, what is a free zone is also to be listed in a cabinet decision. So one must not assume that all free zones are automatically included in the corporate tax 0% rate. The free zone needs to be listed in a cabinet decision, and only those businesses which are then registered in that free zone which is listed and that meet the qualifying income and the substance and the transfer pricing criteria will be subject to the 0%.
Right.
I'll
Now,
pause there, Lorenzo, for any thoughts or questions, because I know this is a topic that's of interest to the audience.
Thank you for that. And there's some good information there be sent across. Maybe Sishan, from your side, I think the issue of operating and polluting your books is something that has come up in some of these conversations, in the sense of, if I know that I'm a free zone entity and I'm going to be operating with people in the mainland, but how do I, if most of my business is done with entities outside and I don't want to pollute what we call pollute my books, how should I go about this? Any thoughts on real case scenarios that you are seeing are happening there, and some advice that we can give on this?
Well, from our opinion, a lot of it is still not cleared from the legislations, but based on what Nilesh has also shared, and from our opinion, they will need to be segregated within the same books for a company who is in a free zone and who has business outside UAE or with free zones, and also business with mainland. They will have to make sure that they are tracked separately. They're recorded in a way in the same books, but in a way that's trackable, so that it helps them make sure that they can identify what would be considered as a qualifying income and what would be considered as a non-qualifying income, because the application of the tax rates will be different for both of these. And it might be at some point be required to do an audit. So these things will need to be tracked properly, separately, and make sure the whole chain of that transaction is properly managed.
Excellent. Maybe Mohammed, I have a question related to you, as I also know that you take care of VAT related matters. I have a few questions people are asking. Since we're already registered for VAT, do we need to register separately for the corporate tax? Can we not proceed with the same system? Is this all under a new system, a separate system? Is VAT going to be separate to corporate tax?
Yes, corporate tax registration will be required to be done separately. Whether you are registered for the VAT or not, you would need to apply separately for the corporate tax. The corporate tax registration is being done through the portal of the Federal Tax Authority.
Excellent. Good. So Nilesh, back to you. You also use the word economic substance, and we tend to confuse, the new regulations related to ESR. How is economic substance now is being linked to this topic of tax, corporate tax, and what can we explain in this regard?
Yeah, I think so. Economic substance regulations have been in force in the UAE since 2019. Most free zone businesses may already be filing the economic substance notifications and reports. The UAE corporate tax now links, and particularly for free zones, links the exemption or the 0% rate to being also satisfying the substance requirement. So if you have a free zone company that earns $1 million dirhams of income with no employees, and all that $1 million dirhams of income comes from outside the UAE, but there are no employees and no offices and no OPEX, and the management of the UAE free zone entities from outside the UAE. All of these arguably disqualifies or fails this economic substance rules that would apply to this free zone company. Now, what the tax legislation seeks to do is it seeks to discourage those businesses that are in the free zone that might otherwise be earning qualifying income and therefore be subject to a 0% rate from setting up companies in free zones purely to take advantage of the 0% rate. So what they're saying is that by all means, free zone companies should be subject to a 0% rate if they earn qualifying income, but provided there is genuine business and commercial activity being carried on by those free zone companies through employees, through office space, through OPEX and arrangements that the businesses conduct in the free zone, as opposed to all of this being done outside the UAE and then free zone exemption is just being availed of, with a view to, to potentially avoiding a tax liability in the UAE.
Mm-hmm. Now, what about income earned by directors and shareholders from their own independent investments and profits coming from their own personal investments and real estate incomes, let's say? Would those be taxable as well?
So you've got that's a nice cue into my next slide, which talks about what's the impact on natural persons, sole proprietorships, and unincorporated partnerships. So if you're a natural person, so directors in your case would be a natural person. Now, a natural person, so like you and me, we're considered as a taxable person if we conduct business or business activities in the UAE. This also applies to natural persons and sole proprietorships. A foreign individual, so that's not based in the UAE, will be subject to UAE as a resident person, again, if they conduct any business or business activity in the UAE. So essentially what they're saying, natural persons, whether in the UAE or outside the UAE, as long as they conduct any business or business activity in the UAE, they will be subject to corporate tax. Now, while a business is defined under the corporate tax law, and this is a very common definition of business that you will see either in other legislations in other countries and similarly in the VAT law, a business is basically any activity regularly and carried on an ongoing and an independent basis, industrial, commercial, professional service activities, etc., exploitation of tangible and intangible property, etc. While a business is defined, a business activity is not defined. So individuals carrying on a business activity which is yet to be notified in a cabinet decision will be subject to UAE corporate tax. So in your example, the directors, in respect of their director fees, whether the activity of being a director constitutes a business activity or not is yet to be defined, or a business activity is yet to be defined. So that's not clear. What's clear, however, is that personal income or employment income, so salaries that individuals may earn, personal income that they may earn, such as if you've got a property and if you've given that property out on rent, the rental income that you earn, any dividend income or gains that individuals earn in their personal capacity without being organized as a business activity is outside the scope of corporate tax.
Yeah.
So that's the distinction. Now, if individuals come together in an unincorporated partnership person to carry on a business activity, as long as individuals come together to conduct a business, which is an unincorporated partnership, it's not the unincorporated partnership is not a taxable person. The individuals will be looked through that and will be subject to tax on their share of profits from a business, but assuming a business or a business activity is carried out. And similar situations apply to family foundations and foundations that individuals may set up for the benefit of their family and other natural persons, or for a public or a benefit or a charitable cause, where the principal activity of the foundation is to manage the savings and investments of the family. Here, the expectation is that they're not conducting a business. If a family foundation is purely managing the savings and investments, it's not conducting a business and is therefore not is out of scope of corporate tax. But if a business activity is conducted by family foundation, then again that is taxable. So it depends on how the individuals conduct their business activity. So if it's a business activity, likely to be taxed. Not a business activity, but a personal income, not taxable. But all of this, a business activity is yet to be defined in the cabinet decision, if that makes sense.
And I guess we would need an entire new session on foundations and how foundations are taxable here in this scope. Foundations is something that is coming up a lot more nowadays. People are understanding that are able to use these structures for ring fencing their assets and putting their assets of the UAE and abroad. I think we will have to go deeper on this. Maybe Zishan, what else can we put forward here for our viewers on these issues of not natural persons, and how does it affect? And one key thing that also comes into the equation here, what is deductible from profits in terms of, for example, salaries to directors and shareholders, bonuses paid? That's a key question that we get all the time. Are those tax deductibles under these structures?
Yeah, so two things here. One, there are questions that we get from clients who are using basically freelance permits to conduct whatever activity they would want to conduct. In those cases also, they are also falling under this law. They would also be applicable under this law. So they would have to do the same things that any other company would be required to do. From salaries or bonuses or remuneration for directors or owners, there is what the law mentions is it has to be on a market value. It cannot be unrealistic or extremely large to bring that profit down to below the threshold. So there will be some way where the authorities either have guidelines or maybe give out cabinet decisions on how this will be managed. That is still to come.
Excellent. And on this topic, Mohammed, of freelancers and sort of the solopreneurs, the smaller companies, I mean, I know of a lot of small companies that are operating. Let's say you're a photographer, you're a freelancer, and you have a freelance visa or a freelance license or a small zero visa license that we call. Many of these individuals are even operating from their own personal accounts. Let's say they're getting paid into their personal bank accounts. How they should be adjusting to this? Are we suggesting that they should stop this, make sure that they have company accounts? Maybe they still don't fall under the threshold of 375,000 dirhams. Are they able to still get paid on their personal accounts if they still show that they're not getting more than 375,000 dirhams worth of profits? What's the recommendations here on these type of scenarios?
On this topic, Lorenzo, they need to get back on their license, whether the license requires them to have a corporate bank account or it would allow them to use a personal. In most of the cases, if they have, for example, zero visa license, which has a legal entity that's separate from the natural person, in this case, they would be required to have corporate bank account to be in compliance. Some other licenses, maybe the freelancer permit wouldn't require them to have a corporate account because it doesn't have a separate legal entity from the person itself. So in this topic, it depends on the type of the license, but for any legal entity, it would need to have a corporate bank account, not to use the personal one. These persons as well will need to look at the corporate tax registration and filing and comply entirely with the regulations of the corporate tax. As Nailish mentioned, as they conduct business activity, they would be within the scope of the corporate tax. Whether they are above or below the threshold, this is something different, but they would need to register, comply with the regulations. At the end of the year, when they submit the corporate tax return, their net profit is the reason that would determine if they would pay tax or not.
Excellent, excellent. maybe at this stage, we still have about over 200 people connected. Maybe if our tech team can include, we have a landing form, a landing page where there is a form. I would like to ask anybody that would like to learn more information about this topic to include your details there. We're going to send you a full document that has a full breakdown of the law and what we know until now of the requirements. And also send us your request. What kind of information are you looking into? And everybody here on the call, Nilesh, Mohammed, Sijan, we're going to be reaching out to you one by one and be addressing those consultations. So please, if the tech team can include this, I see the link there already included. So anybody that would like to learn more, please include your details there. And as we go along, Sijan, Mohammed, and Nilesh, if you would like to include your email addresses there so that people can also address some questions to you directly, we can do so as well. Nilesh, you talked about this topic of transfer pricing and arm's length price. I think this is something that we're getting a few good questions. What is it that people need to know more about transfer pricing and arm's length price?
Yeah, I mean, this is a key topic of the tax legislation, and I think I've got a slide on that, so it can come out real large. So I want to talk about participation exemption also, which we can come back to. But on transfer pricing, essentially, what transfer pricing is that transfer pricing is a global concept, and essentially, the principle of transfer pricing is that businesses must transact with related parties on the same basis as they would with an unrelated party. So the concept is that businesses must transact with related parties on an arm's length basis, which is essentially the same criteria at which they would transact with for goods or services with an unrelated party. The expectation is that if you were dealing with an unrelated party, you would charge an arm's length fee or a fair fee or a market value fee, which is commensurate to the value of goods and services. Now, the tendency is that if you are dealing with related parties, so if I am an owner and I own 100% of company A, and which is in the free zone, and I also own 100% of company B, which is on mainland. Now, a mainland company is taxable, free zone company, if it earns qualifying income, is zero. I may have the tendency, because I control both these companies, I may have the tendency to charge excess profits from the free zone company to a mainland company, or charge excessively for the services, because the free zone company is subject to 0% tax rate. Mainland company, which is taxable, would pay a higher expense or a higher charge to the free zone company and would therefore reduce its taxable profits. Now, these arrangements would not be on an arm's length basis.
But if the free zone company is billing the mainland company, wouldn't that make it subject to tax?
If a free zone company is billing a mainland company, if it's a related party, under the public consultation document, it seemed to be covered. It seemed to be fine. But so I'm saying, assuming that the free zone company still qualifies for the 0% exemption, you would be taxable. Let's take another example. If the free zone company so I own a company A in a free zone and a company B, let's say in Egypt. Okay. And same example, free zone company makes a charge to the Egyptian company, which is not on an arm's length basis. So it makes an excessive charge because it's a related party. The income that's earned by the free zone company is arguably a qualifying income and subject to 0% tax rate. In Egypt, the corporate tax rate is 22.5%. And therefore, my own Egyptian company gets a higher deduction and therefore reduces its taxable profit. So the transfer pricing rules that apply to free zone companies, but also to the wider mainland companies in the UAE, essentially says that if there are transactions between related parties and connected persons, those transactions need to be on an arm's length basis. And that's one of the criteria for claiming the free zone, qualifying income, exemption, or the 0% tax rate. And related parties are defined as natural persons up to the 4th degree of kinship. So spouses, children, dependents, etc. But a natural person and a juridical person can also be a related party, where, so if I own a company, so if in the example that I gave, if I own 100% of company A and 100% of company B, A and B are also related parties. If B owns 50% of company C, that's also a related party to company A. So direct or indirect ownership, common ownership of 50% or more makes you a related person. Then connected persons are those individuals largely who are owners of the company. So any payments made to owners of the company are connected person payments. Any payments made to directors or officers of the company are connected person payments, and those also have to be on an arm's length basis. So you do need to identify who your related parties and connected persons are. You do need to identify what are the transactions between those related parties and connected persons, and then through an transfer pricing, OECD based methodology on transfer pricing, determine what's the most appropriate charge for those related party transactions, and document that in a transfer pricing policy, followed by which of which a benchmark study is part of, to determine and analyze that your related party transactions are on an arm's length basis. Now, this transfer pricing rules have been prevalent in most countries globally. It's now being introduced, and even in the region. So Saudi has transfer pricing rules, Qatar has transfer pricing rules, Oman has arm's length principle rules, and all of these essentially try to dissuade businesses from shifting profits between group companies to take advantage of tax. That's the broad principles of transfer pricing.
And maybe, Sishan, on your side, who will be the auditor of this? Who is going to be overseeing this type of transactions? Is it coming from the Ministry of Economy, the Ministry of Finance? Who is the auditor behind this? And might companies be asked to provide intercompany agreements and documents of such cases?
So the overarching authority that's going to look at the whole of corporate tax and including transfer pricing will be Ministry of Finance. But regarding audits, they will be auditors who will be doing audits. But regarding the mechanism and how things will be done, for now, we know that the transfer pricing rules will be issued, but they will be based on the OECD rules as well. And they will have, if it's similar to them, they have 5 methods that they can be used to determine all of that. Now, whether the local files or the main files, master files are going to be used to be submitted, that is still going to be issued by the authorities as a cabinet decision or another form of regulation, but that will still be announced.
But one key thing here that we're putting out is everybody to start organizing themselves with, if they do have sort of ownership of different entities, and there is going to be transfer pricing, to have this in mind, to set the right agreements and documents in place, so that when this gets questions and asked, there is people can provide answers to this. Correct, Mohammed? Anything from your side on this topic? Anything else that we can shed light on transfer pricing and arm's length price?
Just want to highlight, if you are a single owner of a company, are not related to any other company, or you don't have any related parties or connected persons, you wouldn't need to comply with the transfer pricing. This is only for businesses or persons who have related parties or connected persons that would need to comply with the transfer pricing regulations.
Excellent. All right, Nilesh, I think you have also another important slide, another topic that it was previously shown. I think that's another point. I think it's going really well. We have a lot of questions coming through. We only have 6 minutes left for today. We don't want to drag it, but I think participation exemption is an important topic. We'll let you take a few minutes on this, Nilesh.
Yeah, so just conscious of time, so I'll quickly run through it. But essentially, participation exemption is an exemption provided for under the corporate tax law in respect of dividends and gains, capital gains, So capital gains and dividends that are earned by UAE businesses, whether in the free zone or on mainland. And that essentially is in respect of investment activities, dividends, capital gains on share disposals, etc., that a UAE business may earn. So if you're a UAE company, free zone or mainland, that earns dividend income from another UAE company, another UAE resident person, that dividend is exempt. So if a free zone company or a mainland company earns dividend from another UAE company, those dividends are exempt in the hands of the first company. Okay. To the extent dividend income is earned from a non-resident person, so UAE company earns dividends from a Saudi company or a Bahraini company or an Egyptian company, either that or a UAE company earns capital gains on sale of shares of a UAE company or a foreign company, right? So either dividend income from a foreign company or capital gains on sale of shares of a UAE company or a foreign company, this is subject to what's called the participation exemption, which means that if you earn these sources of income from outside the UAE, dividends or capital gains, either from the UAE for capital gains or from outside the UAE for dividends and capital gains, it needs to meet certain conditions. The exemption or the participation exemption is available if the UAE company owns more than 5% of ownership interest in that company, if it holds that period, that 5% or more, for an uninterrupted period of 12 months or commits to hold it for a period of 12 months. The participation, which means that the investee company in Saudi or in Bahrain or in Egypt is subject to a corporate tax of at least 9% in its country, which some of these countries won't, such as Bahrain does not have a corporate tax legislation, but Saudi does at 20%, Egypt does at 22.5%. This, however, would not apply if you have an income that arises from a qualifying free zone person, because obviously a qualifying free zone person pays 0% tax on its qualifying income. So the 9% criteria does not apply also where there is investment in a holdco that otherwise owns investments in shares which meet the 9% tax rate criteria. So if you have a UAE company that owns a BVI company where there is 0% tax, but the BVI company owns shares in an Egyptian company, because the Egyptian company is subject to tax at more than 9%, and that's the only source of income for the BVI company, then the dividends from BVI company to the UAE company will meet the 9% criteria. The UAE company, the other condition is the UAE company is entitled to receive at least 5% of the profits. And there are some additional conditions which I won't go into, but there are, if you have multi-tiered structures outside the UAE or even within the UAE, you need to look at the ownership criteria or percentage of those indirect investments. But essentially, if you meet all of these conditions, the income, dividend or gains are exempt. So I think the point really is that domestic dividends earned from UAE companies exempt, no conditions. But dividends earned from foreign companies and capital gains earned from sale of shares of UAE or non-UAE companies are subject to a whole host of conditions that need to be satisfied before an exemption can be claimed. So one must not assume that the exemption is a blanket exemption. Now, once we get the definition of qualifying income based on the cabinet decision, we need to see whether how does a qualifying income definition for a free zone company tie in with the participation exemption conditions? Is there an overlap or are they mutually exclusive? That still remains to be addressed. I'll pause here, just conscious of time, Lorenzo. So
no, this is excellent, and I think now we're going into a bit more of the complex type of structuring, and for the purpose of this, to our audience, this is where Nilesh's expertise comes to shine, and he's more dedicated to the more complex structuring side of things and how VAT tax and all of this applies. And from our side as well, CZTA, Creative Zone Tax and Accounting, we're dealing with such cases, but also more with the smaller SMEs and smaller type of entities as well. So anybody that has any questions on this, maybe at this stage, again, I will ask our tech team to put on the link. Anybody that would like to learn more information on any of these topics, please go ahead and include your details on this landing page, on this form, so that we can connect with you and reach out. Maybe a couple of small questions quickly, Sishan, before we close. Neil is asking, is there a document describing the eligibility of expenses related to conducting businesses that could be tax deductibles? For example, he's citing rent or portions of rent for home, office, electricity. Is there such document? What can we put out there to people of things that can be deducted from tax?
Right now, the regulations have a list of things that are covered under deductible expenses. They're mentioned specifically. One example, all the business expenses would be considered, which contribute towards generating that taxable income. One of the examples is, for example, the entertainment expense. There is some restriction that is only deductible up to 50% of the entertainment expense. And there's a difference of how these will also be different from VAT. In VAT, there's no such allowance as well. But in corporate tax, there is an allowance. And yes, there is a list which is mentioned in the regulations, that can be shared with you.
What about the issues of the cases of donations to foundations? This is a very common thing in the US. The donations get deducted from tax. Is this going to be the case for the UAE?
Yeah. So this and some other the government fees specifically will also be something that will be allowed to be deducted from your taxable income.
Excellent. Nilesh, I'm still getting a lot of questions from Joanne saying for clarification, transfer pricing will be applicable only to companies that have related parties. A free zone company will still qualify as a free zone person, even not having connected groups. Is this clear as a question? Maybe.
Yeah, so I think there are some other provisions in the law where transfer pricing can apply even to unconnected persons and where there's potential for abuse. I won't go into the details, but for a free zone company, to the extent a free zone company does not have a related party or a connected person, and therefore no related party or connected person transactions, one can safely assume that they need to, they could be considered to be in compliance with the TP rules. But what that would mean is that as part of the tax return filing, they would need to make a declaration, are expected to make a declaration to the effect that there are no related parties or connected person transactions, and therefore that condition is complied with.
Excellent. Great. So, well, conscious of time, we're slowly going to get to the end of today. There's hundreds of other questions that are coming through. I suggest again to all the attendees, put your questions on this form. We're going to get to you one by one. We're going to connect with you. Maybe as a final, some final thoughts for today. From my side, what I can see is still there is quite a little bit to be clarified and to come through from the regulation itself, from the ministry and from the authorities. I think as a business community, we should not be in a panic mode. It's a time for us to get organized, for us to consult with such partners of Creative Zone Tax and Accounting and Nilesh and his entity. I think it's a time for us to prepare ourselves, but I can still see that there is a lot yet to come from the top, right, Nilesh? So what would be your final thoughts on where we're at and what we could put forward as a final comment today for the attendees?
Yeah, I think you're right. There's a lot that still is to still needs to be done. But I think what businesses can already start doing. I don't know whether you can see my screen, is a few things that businesses can start doing already. I mean, look at your residential status, and are you conducting a business activity or a personal activity? Look at, obviously, it's a no-brainer, looking at your free zone exemption or qualifying income exemption and a small business relief, whether you fit the criteria once that's announced. We didn't talk about this, but you have the ability to form a corporate tax group if you own 95% directly, indirectly, or commonly, and you get an administrative relief by filing a tax group, filing as a tax group. So look at those as an option. We talked about related party and connected person transactions. The first step is really identifying whether you have a related party or connected person based on the rules, after which you can perform the transfer pricing analysis to be in compliance with the rules. If you are, then there is a whole host of transfer pricing documentation that needs to be prepared and maintained by businesses, and this will need to be either filed with a tax return or can be requested for by the FTA at the time of an audit. There are, on expenses, there are interest deductibility rules, which are fairly complex. So those need to be looked at where you have a company that has significant amount of related and third-party debt in the business. To the extent you are looking to restructure your operations, given corporate tax coming in, be mindful that there are certain anti-avoidance rules that will impact you. So if you take any restructuring step purely with a view to obtaining a tax advantage, those may be disregarded by the FTA. So be careful when you do some significant level of planning or restructuring to your business. Look at the impact of tax in your accounting projections for FY23 and 24. Consider whether you need to create any deferred tax impact or liabilities. And then, finally, when the registration opens up, and once you've done the analysis, you can apply for tax, registrations, whether it is as an individual or whether as a group, if you're forming a corporate tax group. Now, this is just an outline or an illustrative of some of the things that businesses will need to do. Some will be more applicable to some businesses, others may not, but those are some of the handful things to do. But I think the overarching message really, Lorenzo, and for the businesses on this webinar, is that we do need to spend time preparing for the corporate tax introduction. And I think, unlike VAT, where the filings are regular, even though corporate tax filings are after the year end, the preparation has to be done now before the law kicks in.
Mm-hmm. And I love these quotes you're sharing.
I use this often when I talk about taxes or new taxes coming in. So
it's all about preparation. I think more than ever at this stage, it's all about us getting ready and preparing ourselves. Definitely. Sishan, your final thoughts for today?
Similar to this quote that we have on the screen, I would really want the businesses to assess their structures, their company, how they're structured, how they have their assets, their expenditure, are they properly managed? One thing that we see commonly with our clients is the books are not maintained properly. So some time needs to be spent on all of these to make sure you're being compliant and also making sure that you are paying taxes efficiently.
Mm-hmm. Excellent. Mohammed, your final thoughts?
The same, Lorenzo. Now it's time for preparation. I would say now it's time for assessment, preparation, arranging of intergroup transactions, and the transactions with related parties, starting looking at the transfer pricing. Now it's a good time to prepare, so you wouldn't have any issues or any complications at the time of the law would be effective for your company.
Excellent. So gentlemen, Nilesh, Sishan, and Mohammed, thank you so much for taking the time today. To all the attendees, we would like to thank you. We had over 200 people connected. We are getting a lot of questions, people saying, are you going to send us a copy of the recording? We will follow up with an email to this. We're going to also include the presentation that we have shared today so that you have a bit more information. And please do connect with us on that landing page, on that form. Include your inquiries so that we can reach back to you and treat these one by one. But from our side at Creative Zone, we're here to help. Creative Zone Tax and Accounting, our entity, and Nilesh, a partnership we have with Nilesh for many, many years. Nilesh, we thank you for this collaboration, and it's always such a pleasure to have you here with us.
Pleasure. Thank you, Lorenzo, and the team for having me on the webinar.
Thank you. Thank you all, and we will see you again in the next one. Goodbye for now.
Thank you. Bye-bye.
Thank you. Bye-bye.